The crowd just watched the Magnificent Seven rip the market higher again, and a lot of people are acting like the game is already over. Here's what actually happened. In 2025, the mega caps sprinted from a brutal spring sell-off into fresh highs, and anyone who tried to do value got laughed at, until the next punch in the face. Because the truth is simple. Price can float for months, but value is gravity, and gravity always collects its debt. I'm your host, and this is our channel. We don't chase candles. We measure businesses. And yes, subscribe. If you want analysis instead of noise, hit subscribe. Now, 12 months ago, we built our own anti-Magnificent Seven. 7 companies we believed could beat the celebrity stocks over the long run. Not because they're trendy, but because the price you pay is still human. And the first surprise? We didn't win 2025, not even close. The big names finished the year up roughly a quarter, while our 7-stock basket crawled to a small single-digit gain. That gap is the kind of thing that makes weak hands panic sell at the bottom and buy back at the top. So let's be very clear about the setup going into 2026. Fact, the market rewarded what was already expensive. Fact, our basket got punished, mostly because boring doesn't trend. What that means, we're walking into 2026 with a watch list that's cheaper relative to value than it was a year ago, while the crowd is paying premium prices for perfection. If that sentence makes you uncomfortable, good. That discomfort is the edge. Now watch this. The Magnificent Seven are legendary for a reason. They've carried the index, they've dominated cash flows, and they've printed shareholder value for a decade. But the part no one wants to talk about is the math of expectations. When a stock is priced like it will win forever, it doesn't need to fail to hurt you. It only needs to be less perfect than the price demanded. That's the trap. Think of it like buying a concert ticket. If you pay a fair price and the show is great, you're happy. If you pay 10 times face value, even a great show feels like a scam. Stocks are the same. Great company, bad price, pain. So we ran the mega caps through our valuation lens, using assumptions we'd actually defend in a real conversation. Revenue growth, margins, and what the market might pay years from now. And the group return wasn't exciting. A few looked fine. A couple looked stretched. One looked like the market was pricing in a miracle. We're not here to bet on miracles. We're here to build a portfolio that survives reality. This is educational. We manage risk. So here's the playbook we're running. Price versus value is the whole game. Cash flow quality beats story quality. Returns on capital tell you who can compound. We buy when the crowd is bored or disgusted. We use volatility, not emotion. And here's a detail the charts won't tell you. We still hold most of this basket. A couple positions got taken from us the quiet way, covered calls. The market ran so far, so fast, that we got paid, and our shares got called away. One of those names later fell hard from where it was taken, reminding us why we sell calls only when price looks silly. That's not luck, that's process. Now answer this in the comments. Do you want a portfolio that looks smart this month, or a portfolio that compounds for 10 years? Okay, let's go inside 2025, because the pattern matters. Early in the year, the market cracked. When the floor drops out, the most overloved names fall hardest. For a moment, our basket actually led. Not because we're geniuses, because valuation is a seatbelt when the car hits the wall. Then came the whiplash. A policy headline here, a rate rumor there, and suddenly the market went from panic to party in a handful of weeks. That's when the celebrity stocks did what they always do in a liquidity wave. They levitated. Spring turned into summer and the mega caps kept getting votes, even when the valuation receipts started stacking up on the table. By late summer, the gap widened. Not because our companies collapsed, because the crowd was bidding up what it already owned. And in the final stretch, we took the punch. A few of our names cooled off, the mega caps caught another wind, and the scoreboard looked ugly. Here's the twist. That ugly scoreboard is exactly how the next decade's winners usually start. Because momentum looks unbeatable right before it exhausts. And value looks stupid right before it works. So 2025 wasn't a verdict. It was a temperature check. And temperatures flip. So what are we doing in 2026? We're leaning into companies where price and value are disconnected. Not because we hate the mega caps, because we respect math, because it is hard to beat the market when you start the race with a backpack full of expectations. Now we go, name by name, Ulta Beauty. Beauty spending is one of those weird human constants. People cut vacations, they cut gadgets. They still buy the little rituals that make them feel normal. Ulta owns that lane, a loyalty engine with tens of millions of members, a store model that blends products with high-margin services, and partnerships that put the brand where shoppers already go. The business has been throwing off close to $1 billion a year in cash, and that matters, because cash is oxygen. Here's the metric we care about. Return on invested capital. One-line definition, how much profit a company generates for every dollar it reinvests. Why it matters. It tells you who can compound without needing a miracle. Applied here. When a retailer earns strong returns, every new store is a little factory. It throws off cash, funds the next store, and the snowball gets heavier. Now the trap is obvious. When the stock runs hard, people confuse momentum with value, but price can sprint while the business jogs. So we separate the two. If shares trade at a premium because everyone suddenly discovered the company, we don't chase. We set a range. We let the market come to us, and if it doesn't, we don't cry. We move. Southwest Airlines. Yes, airlines are brutal. Fuel, labor, weather, geopolitics. An airline is basically a flying stress test. But this airline has been a different kind of operator for a long time. Historically, it stacked profitable years like bricks in an industry famous for bankruptcy. Then the system strains showed up. Technology issues, operational headaches, cost pressure. The market took those scars and priced the company like it forgot how to execute. That's where opportunity can live. Because this isn't a new product story, it's a fix the machine story. If the machine gets fixed, the earnings power changes. And even analysts who usually move slow are modeling a sharp jump in earnings over the next few years if margins recover. But the downside is real. High capital needs, thin margins. One bad shock and the whole thing coughs. So we size it like adults. We're not gambling, we're measuring. PayPal, the chart looks like a broken promise. Years of grinding down, people calling it irrelevant. But over the long arc, revenue rose, and the company kept generating cash even while the stock price bled. That's the dislocation we hunt. Because when the market gets emotional, it pays less and less for the same dollar of cash flow. At points, this business has traded at multiples that scream no future, even though the platform still moves money for the world. And when a company buys back shares at low valuations, it can quietly boost per-share results without fireworks. This is where the crowd gets trapped by optics. They look at a price that fell and assume the engine died. But sometimes the engine is fine and the market is just repricing growth expectations. So we look underneath. Cash flow, share count, competitive positioning, and we watch behavior. Are they buying themselves back or are they diluting you? Now here's the thinking question that separates tourists from investors. If revenue is up over the long arc, why is the market paying less for every dollar of that business today? Alibaba. This name comes with noise, regulations, headlines, sentiment swings. And sentiment is the point. Because when a strong cash engine sits under a cloud, price can detach from reality like a balloon cut loose. The market cap is massive, the platform is massive, and yet the stock can trade like it's guilty until proven innocent. Now, we're not naive. There are real risks, policy risk, competition, macro, and the simple fact that you don't control the rules. So we treat it like a risk position, not a religion. But we also respect what it is. A scaled marketplace and cloud ecosystem that can generate billions in cash when spending cycles normalize. And we use discipline. Sometimes we lose shares not because we changed our mind, but because we sold covered calls when price ran ahead of value and the market ripped through our strike. That's not tragedy. That's getting paid to be patient. If price comes back into range, we re-enter. If it doesn't, we don't chase. No ego. Adobe. If you work in design, media, creation, and this ecosystem is infrastructure. The margins are fat. Gross margins around 90% are not normal. That's software printing money. Recurring revenue is sticky. The product suite is woven into professional workflows like electricity. The market got spooked by the AI narrative, like AI was going to delete every creative tool overnight. That's a story. The real question is simpler. Can Adobe integrate the new tools into the moat and keep charging for value? If yes, then a price that got chopped from its peak is not a death sentence. It's a reset. And when a company throws off roughly $10 billion in annual cash flow, it has weapons. It can buy back shares. It can invest. It can wait out narratives. Businesses with extreme margins don't need heroic growth to be wonderful. They need consistency, buybacks, and time. Nike. When the crowd turns on a brand, it's loud. China weakness, consumer shifts, inventory mess, margin compression. And the stock gets treated like it forgot how to sell shoes, but brands don't evaporate overnight. They wobble, they restructure, they clear inventory, they rebuild product cycles. Inventory cleanups look ugly because margins get sacrificed to clear shelves. But once shelves are clean, pricing power can come back. So we ask a brutal question. What does the world have to look like for Nike to be irrelevant 20 years from now? Not down this quarter. Irrelevant. That's the filter. Because if the brand survives and margins normalize and the price you pay is reasonable, you can earn strong returns without needing the company to become something new. You just need it to stop bleeding. Sprouts Farmers Market. This one went from loved to punished in a blink. A sharp run, a euphoric peak, then a fall that reminded everyone that price is a wild animal. But the underlying trend, health-focused demand, private label margin expansion, disciplined growth, doesn't vanish because the chart got ugly. This company is small compared to the giants, which is the point. Small can still grow stores. Small can still expand margins. Small can still surprise. Retail at scale is a game of pennies. If you lift margins a little, the entire earnings profile changes. That's why we watch it. And that's why we're willing to step in when the market offers it back cheaper. Now, we need to talk about the real engine behind this entire approach, valuation. And we'll keep it simple without insulting your intelligence. A company is worth the cash it will generate in the future, discounted back to today. So our levers are only a few. How fast revenue grows, how much of that revenue turns into profit and cash, and what multiple the market might pay when today becomes 10 years ago. That's it. And this is why we think in ranges, not single numbers. A business is not a sticker at a grocery store. It's more like a house. Two identical houses can sell for wildly different prices depending on the mood of the neighborhood that week. Value doesn't change that fast. Mood does. So we build 3 lanes in our heads. A cautious lane where growth is slow and margins stay average. A base lane where the business does what it has historically done. And an upside lane where execution improves and buybacks shrink the share count. If price is below the cautious lane, we pay attention. If price is below the base lane, we get aggressive. If price is above the upside lane, we don't argue with it. We sell calls, trim, or wait. That framework keeps us from falling in love because love is expensive. And the market punishes expensive emotions. One more thing. Share price is a trick. A $60 stock is not cheaper than a $600 stock. The only question is, what do we get for the dollars we put in? Cash flow, durability, and the ability to reinvest at high returns. That's the whole measurement. If we can't explain why it will earn more cash in 5 years, we don't own it. Simple. No excuses, no shortcuts. Everything else is noise dressed up as sophistication. And here's the trick. We don't need to be perfect. We need to avoid overpaying. Because overpaying is the one sin that removes your margin of safety. You can buy a great business and still lose money if you pay like a desperate fan. So when the crowd is euphoric, we slow down. When the crowd is disgusted, we speed up. That's the inversion. Now let's talk about the tool most people misuse. Options. Options are not a lottery ticket. They're a pricing tool. We sell covered calls when the market is paying us ridiculous premiums, and the stock is above what we'd happily sell for. We sell cash-secured puts when we want to own a business, but only at a lower price, and we want to get paid to wait. That's not gambling. That's turning volatility into income while staying married to valuation. And yes, sometimes a call gets exercised and shares get taken. That's not getting wrecked. That's executing the plan. Now, do not twist this. If you don't understand options, don't touch them. But if you do, they can help you enter positions with discipline and exit positions with less emotion. Now, zoom out again. Why do these 7 names matter going into 2026? Because they sit in different lanes. Consumer resilience, travel recovery, payments infrastructure, global e-commerce, creative software, brand power, health retail, different engines, different narratives. One common thread. The market has mispriced at least a few of them relative to long-term cash flows. And we don't need all 7 to be home runs. We need a basket where the downside is cushioned by valuation and the upside is fueled by normalization. Now, here's the warning nobody likes. If the overall market takes a big hit in 2026, the most expensive names can fall the farthest. That's not hate. That's math. And if that happens, people will panic. They'll sell what they can, and they'll dump quality along with junk. That's when our buying window opens. So we're not praying for a crash, but we are prepared for one. Because preparedness is the difference between opportunity and trauma. Now watch this contradiction. The same people who scream buy quality at the top disappear when quality goes on sale. They buy comfort, not value. We buy value, not comfort. So here is our operating rule for 2026. We don't buy because the stock is up. We don't sell because the stock is down. We buy when price is below our estimate of value and the business remains intact. We sell when price runs far beyond value or when the thesis breaks. Simple, hard, effective. And I want one more comment question from you because it exposes mindset. If we're wrong, where will it show first? Revenue, margins, or cash flow? Drop your answer. We read them. Now, you might be thinking, okay, but what about the Magnificent Seven? Are we saying they're doomed? No, we're saying expectations are high. And when expectations are high, your future returns get squeezed. You can still make money in great companies, but the price you pay decides whether the next decade feels like compounding or like running on a treadmill. So we're building a portfolio that can compound even if the market mood shifts. We're building a portfolio that doesn't require perfection. And that is the whole point. Now, let's land this with clarity. We are not chasing the most talked about names. We are stacking positions where the cash engine is real and the price has been discounted by boredom, fear, or temporary mess. We're going into 2026 with patience, with a list, and with levels. And when the market hands us fear, we convert it into ownership. Subscribe if you want to keep running this playbook with us, because the crowd watches price, we watch the machine, and the machine always wins.